Morning, everyone. It's Andrew with Supercharged Stocks. Today, I'm pleased to have Fred Jones here, who's the CFO of Pan Pacific Resources Investment. Very excited to talk to Fred here because we've got Merrill Lynch in common. That's one thing. Right. But this is an interesting conversation for a couple different levels because we're getting a look at institutional investment banking kind of level knowledge coming into the junior markets here in Canada. Because you've worked for big name companies like Bear Stearns, Morgan Stanley, Merrill Lynch, in places like San Francisco and London. So you're bringing a level of knowledge and expertise to this market, which we don't see that often. So this is what's so interesting. It's education for people, and we're going to get to highlight on how we were able to attract you into this sector, what really got you excited about it, and where do you think things are going, and the vehicle you have to really take opportunity of this kind of in ahead of the curve, as I call it, of really grabbing hold of this sector. So happy to have you.
Thank you.
Let's get at it. What? Tell me a little bit about yourself and what got you excited about commodities in general, and especially mining.
Well, I think I've always had an interest in commodities and the commodities sector. So I started my career as a bond trader, actually, and then moved on to the currency desk. And when I joined Merrill's, that's when I started to get a bit more of the commodity exposure. So the dot-com boom was getting going, and all the money had left the resource sector. So that created quite the opportunity in distressed debt of mining companies. So what I found was that the companies, in many cases, I wouldn't say cash rich, but their balance sheets were very strong because they were forced to fund themselves when the market would not allocate any capital their way. So the survivors had very strong balance sheets, and their bonds were selling at anywhere from 80 cents down to 40 cents on the dollar. So that created an opportunity that no one really cared about. So to be able to buy these bonds and essentially earn 3 years of coupon, yields in the double digits, that made sense. Yeah. That made sense to me. It just, chasing, the dot-com stocks kind of left that for someone else.
No, I like that. Whenever someone can see that opportunity in an inefficient market, and instead of saying, I'm going to chase the trend, and that's, people chase the trend, and that can work and lull you into a sense of confidence, and then you get hammered down.
Exactly.
I always like it and look for value is that if I can find an inefficient market that has a lot of value, no one's looking at it, that's where you can accrue real value, real gains. So I'll let you kind of go forward from the bonds. You started looking at more of the commodities and.
Right. Well, so what I thought was that, there was kind of more than one way to sort of pursue the commodities market. So at the time, and this is in the 90s, if you wanted to be involved in commodities, you'd have to set up a futures account. Physical commodity firms were just that. They were really, and they still are really, supply chains and logistics companies. So beyond that, you could buy the equities. As I mentioned, no one was really interested in the equities. Technology was attracting more and more money. So effectively, you were watching the flood of capital leave the commodity sector. And that continued basically unabated, I'd say until about 2000, gold peaked up, and then the other metals followed, and energy and so forth. And then, of course, after the GFC got started, money flooded out, went into cash, largely US dollars, commodities that were resurgent for a couple more years. And then after gold peaks in 2011, money again fled the sector. So because you had sort of this boom bust in capital flows, one thing, especially if you were playing commodities from the debt side, because for me it made more sense, I could go into the debt of a company whose stock was paying maybe a dividend yield of 4%, 5%. That's attractive, but the bonds were paying 16 or 17%, and the balance sheets were solid. I preferred to play commodities that way, especially in the environment of a declining dollar. If you were finding the bonds that were denominated in euros or sterling, that sort of gave you an extra 300 to 400 basis points in return on top of yield that you were earning. So that went on basically until it didn't. But one thing that I found was that the debt markets they're illiquid. So when you're talking about distressed debt, you can enter a position, but good luck leaving if you have to. So you kind of go into sort of a private equity mindset, whereas private equity, sort of 3 to 5 years exit with distressed debt. If you're buying 3 to 4 year bonds, and you could monitor the credit situation, you were quite happy to sit there, clip the coupon, wait for the yield to maturity to express itself, and again, double-digit yields over time. That was an investment model that made a lot of sense, and there weren't a lot of people doing it. Specialist firms, but no one in particular. Yeah. Just wasn't something people were interested in.
And this is interesting because it really is this culmination of having that specific skill set. Like, as you said, if anyone's really drawn to a commodities market, they're often more aggressive and they'll go straight to futures. And that's fine. And that's, I mean, hey, if you've got the stomach for it and you want to be really speculative and leverage, yeah, go knock yourself out. But what's really interesting is because you took it at, you have to look at balance sheet, you're looking at the bonds, you're looking at the actual structure of the company. This then lends itself to kind of where we're at today, where you're saying, I know how to value the equity of a company. I can look at the projects. I can see that there's a value now in this sector. And that, I think there's a level of credibility there because you've come from up here at the top of the finance world, and you're now looking at this junior market that I also like, and we share being at Merrill as well, that we have this opportunity that's in front of us. And it seems like this skill set you've honed has given you to this point now that we're at with Pan Pacific.
Yeah, so Pan Pacific, and again, part of the back context, one thing that I found when working in sort of the bulge bracket banks, there's also sort of a boom-bust cycle within the banks as well. So they tend to allocate resources where they believe capital is flowing. So again, trading desks, research departments, the asset management arms allocated more research towards tech research, tech banking, tech asset management. So mining analysts, fired, laid off, made redundant. The trading effort, they're not really allocating much money to trading, bonds in the mining sector. They consolidate. So there is sort of a cyclical boom-bust cycle that goes on within banks. So when you're talking to banks and you're saying, well, listen, we'd like to, issue, this and bonds of that. Well, we really don't have an analyst that follows that, or, we're not really doing that right now. So you can kind of see indicators throughout sort of the banking and finance infrastructure that the support for mining and resources isn't what it was, say, 10, 12 years ago. Yeah. So that is changing, and I think it will continue to change because, again, banks tend to follow where they believe the capital is flowing. So we set up Pan Pacific specifically to basically examine and then invest in capital flows that are migrating from what we believe to be over-leveraged, overvalued sectors. Financial center real estate, tech stocks, all of these things that are probably likely to see some liquidation, some partial liquidation over the next 5 to 10 years. And we think it's going to be longer cycle, and we think that money will migrate towards the value sectors and sort of the cheapest sectors, asset markets. And commodities would probably be the cheapest broad-based sector in our view. So we set up Pan Pacific to do that, and we expect that other things in the cycle will change. So as money flows, we'll see more support from the investment banking business that will support our efforts as we build out our portfolio. So I think if I were to look at Pan Pacific and say, okay, on one side, it's a little bit private equity, it's a little bit commodity trading, it's a little bit M&A. In reality, Pan Pacific is a sophisticated multi-position portfolio spanning seed level equity, convertible debt, offtake and streams, which allows investors that may not have 10 to 15 years experience in the commodity sector to invest in a diversified portfolio run by the specialists, and they enter, at least on the equity side, which is about 65% of what the portfolio ultimately will be, at the seed level. So advanced projects, but at the seed level, which is very difficult to do.
Yes, and this is where this is so interesting because we're tying in a lot of things here. One, I mean, Goldman Sachs is on your side too, talking about this cycle that's occurring, this super cycle that's occurring. So I often try to remind people that it's not just me who thinks this, and it's not just you who thinks this, because we're both self-interested. We both love this sector. Goldman Sachs is out there, and they're saying this is happening. So we've got a good structure. You've got the structure here where it's attracting a lot of family office, private money. That seems to be the first inflow. But you've also made it so a generalist investor can get involved, and they can get involved early, which is where you want, and they have the opportunity to learn as they go as well for the types of products you have. So you're attracting the smart, sophisticated money that goes, I do want to talk about physical commodity and what we can do with that. I want to talk about this, but also if someone could go, well, how do I get involved and take advantage of this? I don't want to have to jump into a stock that's already had a 10 times run up. Right. How do I get involved early and look at projects before trying this massive inflow of cash comes in?
Right. So there is sort of a process, or sort of a kind of an ABC step. Typically what you'll see as you identified sophisticated investors, generally people that have spent their lives in the industry, very specialist investors. They're the ones that are typically left at the end of a commodity cycle. And then you will see some retail players, then the specialist institutions, the mining equity guys. There are a few of those out there, right? Van Eck, Tocqueville, which I think is part of Sprott now. I see those names coming in. And then you'll see more generalists. And typically you will see a larger wave of retail money. In the mining sector, it's so small that it's very difficult to absorb very large capital flows, which is going to be an interesting problem to see how it gets resolved in the cycle, because right now you look at the market caps. If you're a generalist, if you got a lot of money to put away, you're limited to sort of Newmont, Barrick, of the largest of the large players. You know, Franco-Nevada, that's a streamer, still very large. So you'll either be faced with a situation where these issues are going to richen, their bonds are going to trade very rich, almost perpetually. How are you going to open up, other elements of this? And this is why we think, as the cycle goes on, you're going to see more money sort of go down the curve at earlier stage opportunities. So where we've positioned Pan Pacific, we do have some producing assets in our portfolio, but where we think the sweet spot is advanced projects, pre-production.
Yes.
So yes, you will see a lot of money flow into earlier and earlier stage exploration opportunities, more property plays, so forth. That's yet to come. If we want to balance our risk, we have preferred to buy into properties that have had a significant amount of work done on them, coming out of companies that sort of overissued in the last cycle, and so they tend to be, we say property rich, cash poor.
Yes, yeah, I like that. Yeah.
That's where we've been finding the opportunities. We'd prefer to stay there. We just think it's a bit speculative at this stage to start looking at things that are too early stage.
And people like to talk about these greenfield projects like a new discovery and out in the middle of nowhere. Those can draw like, ooh, we're elephant hunting. That's exciting. But that's very different. And that's a big game hunting. We're going to swing for the fence. And that attracts one type of person. This is different because this is saying, if you try to put $100 million into this market right now, and that's not even a relatively big sense of the number. Like people might say, oh, $100 million. You could put $1 million into 100 different issues. That still is a decent move. Right. If you put $1 billion or 10 billion, that's still not even a blip for Apple or Tesla or NIO. Exactly. This isn't even nothing. I mean, we were talking today about GameStop. That thing just going through the roof from $20 up to 140 at one point. It just moved. That's billions of dollars of market cap on one stock. So this can flow in. And what people are going to look for then is that I want a project that has been sitting in reserve because we couldn't do it because of either infrastructure, the price wasn't there, and the demand wasn't there. We have the demand. We know that we have the demand. So a lot of these projects, they're not forgotten. They're just sitting waiting. So when people at generalists goes, well, how come you didn't develop them? Well, because there's projects waiting for copper prices or for gold prices to catch up. And these is where you're able to come in, swing in, pick these ones up, these projects that people couldn't hold on to. They, 6 years of trying to hold on to this piece. and you're leveraging that you're able to get it for a spot price right now. Right. And while we enter this boom in this commodity cycle, you can then advance that project.
Right, right. So you identified a number of issues, and again, I suggest it's going to be interesting to see how they kind of resolve themselves. Okay, so the first issue is one of capacitance. You have projects that they would be overcapitalized, for example, at $100 million. But now you've got pension funds and investment managers that have hundreds of billions of dollars to put to work. $100 million is a rounding error. Yeah. So how do you get money to projects in a way that can actually turn the crank for the investors? So you've got that disconnect. And then you've got, well, we want to put money away. We see there's value there. We're into the capacitance problem again. How do we sort of get around that and still control our risk? So what ends up happening is you might see money going down the curve very quickly, because instead of saying, okay, we've got $100, $200 million to put away, and we're going to put it away in sort of a large market cap issuer, and then they allocate, eventually what will happen is you pay some money up front for property, and the rest of the money that you have to invest kind of goes into development, you see. So in many cases, I think institutional investors, portfolio investors, might turn into unwitting venture capitalists, again, because of sort of the development, the capacitance issue, the fact that mines take years to develop, and they're going to have to be patient. So I think you're actually, as a result, you're going to see changes in the market structure.
I kind of hope, give me your thoughts on, is that if you look at, say, a biotech or pharma play, or you look at even just an Apple or Amazon, and they just do an M&A type of play, is that they get other companies that are developing technology, they keep an eye on them, maybe they have someone on the board as a small company is developing, and then they snatch them up, and they're like, we need that technology, we can use it. Right. Is if we can start to look at that as going, the R&D in the mining sector is all of these people pushing and advancing projects, doing all the hard work, doing all the geochem, doing all the soil samples, doing all the drilling. And once you can develop those, depending on where the prices of whatever commodity happens to be, if we looked at that as being, that's just R&D, these people, these funds can then apply themselves. That's my hope, is that we could take that kind of model again and apply it towards this mining sector that would allow a lot more cash to come in.
Right. Okay, so not only would there be changes sort of in market structure, there would be changes, I think, in sort of the wider infrastructure for this, which means students increasingly are going to be choosing geology. You're going to see more money put into mining engineering and infrastructure development. You're going to see more money going into developing, say, the power and the road structures around mining districts, right? You could see the development of new residential areas, new towns. Yeah. This could be, and this is all funded again by investment. So, kind of taking a step back, I was having a conversation with a colleague in my office about 5 years ago, and it was like maybe January of 2016, and we were looking at the price of gold, and it was at about 1075. And we agreed that the next cycle, whenever it would get here, would likely be characterized by private money. Partially, again, because of capacitance, but also because people that wanted to invest in the mining sector didn't necessarily want to invest in a corporate balance sheet. They wanted to go directly to the project. So they would say, okay, fine. You got this great project. We believe you. This is what we're going to do. We're going to have our own geologist out there. We'll buy 70% of it. We're going to ring fence this away from the rest of your balance sheet. We're going to put it into a joint venture, and we'll own 70% of it. You can run the exploration. We're going to appoint our own sort of overseeing geologist, and we are going to take more of an active stake in the development of it. So it turns into something. That's fine. You'll own 30% of it. That's great. You won't be able to borrow money against it. We will sort out all the financing, the capital raising, but we want to control basically how much money. We don't want to run into a situation we ran into the last cycle where, again, you overprint stock and everyone's kind of sitting around dead paper in their portfolios. Yeah. We don't want this to happen. Yeah. So that would be sort of the first step towards what we see as, again, private money led, and larger investors sort of being compelled to think like long-term private equity investors, private investors, in terms of, you're going to invest in something and you're going to have to watch it develop. Okay, you're not going to be able to just put a couple $100 million into something and own the equity. There's just you're going to have to let the market develop.
Yeah.
And so I think part of the early risks are you could see a small boom, just reflecting sort of the first wave of money. Not that it's a lot of money, there's just nowhere for it to go.
Yeah.
Possibly, again, an overprinting situation, a bit of a bust, the money is chased out. Again, so you're going to see some of these smaller cycles within a much larger, super cycle, if you want to call it that. So those that we expect will win are going to be positioned to deal with that sort of volatility. And that's why we've structured Pan Pacific the way that we have. So going in, basically buying properties that we understand.
Yeah.
We've got a fantastic technical team. Somewhere between 125 and 150 properties we look at actually comes up to the investment decision level, the negotiating level. So, and again, because PPRI are private at the moment, we can take our time, we can structure publicly traded companies, we can coordinate the funding, and we kind of insulate ourselves and our investors from a lot of the volatility that we're going to expect as the cycle rolls on.
Yeah. Now, are you commodities agnostic? Are you your preferential treatment to some, or are you kind of looking at all, or what's kind of the wheelhouse that you're really kind of paying attention to in this portfolio?
We're metals focused at the moment. Yeah. So precious and base metals and battery metals. Yeah. Copper, gold, silver, cobalt, nickel. We want to kind of keep the focus fairly tight. If you try to do too many things, for example, energy, very different. We think there's an opportunity there. There might be a way to structure something to capture that opportunity. Our collective background is in metals. It's in mining. It's in mining finance. It's in mining portfolio management. That's where we're strong. That's where we like to stay. That's where we understand the opportunities. That's where our technical team is strong. So anything kind of outside of that, you risk doing investors a bit of a disservice, right? Because now you're going into areas where you've got other very strong players, and we really don't want to do that.
Yeah. Now, you've mentioned your. A lot of people are going to see this, and they're going to go, "I like this guy. He knows what he's talking about," and they're going to buy into the thesis. They're going to go, "This is good. This is smart." So, two, they're going to think, "Okay, you're private. How do I get involved with this? How I like this? How can I invest? Can I get invest?" And two, can we talk a little bit about this technical team as well? Sure. And so maybe let's talk about the technical team first, sure. And that'll lead us into the next stage.
Sure. So we have, as part of the PPRI team, we've got a strategic and technical advisory group, board, if you will. One gentleman who's a qualified person, and then we've got 2 GOs. So we constantly have people looking at projects all the time. One thing about us, we set up, and our technical people for the most part are based in Calgary. And so we've got a database there of about 13,000 properties around the world. And originally we were going to set up sort of an investigative unit, if you will, that would go into these properties, find out where exactly they were located, get the data, find out who owns them, so forth. The reality is, because the individual members of PPRI have been in the game so very long, all the calls are now inbound into us. I don't think we've made a single outbound call on a property. Now, this is relevant because it keeps us out of competitive bidding situations. I think in our portfolio, we might have one property that might have been subject of interest by another group, but the seller basically, once we showed up into the frame, they negotiated with us directly. And so again, we can go in, we can negotiate without the pressure of paying up for property, the disappointment at not being able to find something. Yep. And we like that. Yeah. We like that. And what it does is, because people sort of know what our criteria are, many of these properties are already, coming to us pre-vetted in a sense. Yes. Right. So it's been good, and it's basically allowed us to, since June, position, 4 assets in the portfolio already. So we're moving quite fast.
So is there a way for someone, whether it's a family office that wants to reach out, or even an individual investor, must they be accredited? All these things. Who are you looking for? Who, if someone calls up, says, Andrew, I really like Fred, how can I get involved? What do they have to do?
Right. Okay. So they do need to be accredited to invest in PPRI. So if I can just digress a bit slightly, part of our model is we are originating deals and we're incubating companies. So at some point we're returning capital early in the process to our investors through a partial spin out of companies in our portfolio. So we've taken in the assets, we've created a public company, and we've done a partial spin out to the investors of Pan Pacific. Shortly thereafter, there's an IPO. At that point, people can buy into the publicly traded shares. They will not get the seed investment price. They might get the IPO price, but they are able to participate. If you are an accredited investor, that is where you get access to a lot of the private deals that may not be going public through PPRI, the convertible bonds, the project financings, the bonds with an embedded commodity swap, all the funky stuff, all the fun stuff that really does add alpha and creates significant cash flow.
Yeah. So this was so interesting too, because you have this portfolio and range that someone can get involved at the level and technical ability that they have. And that is rare. It's to have someone that has a level of sophistication to apply a lot of different tools, specifically because you're talking about a lot of private money, equity, and family office stuff. They need to have a lot of flexibility. So having someone like yourself and a lot of this capital background adds a layer that a lot of companies just don't have access to. They just don't. So this is what makes this really unique, is that not only can someone get in, and I like to use the cash phrase, in ahead of the curve. So you're getting in early. You're going to offer them a portfolio and a lot of options as well on top of that to continue to get in early to projects that you guys like. Right. So there's not a lot of people doing that out there right now.
Not too many. There are one or two that do get involved in originating deals. We haven't seen anyone out there that has our model sort of end to end. There are talented people out there. Many of them were sort of left over from the last cycle. I think they're being taken up. So we were in the market for talent early. By doing so, I think what we've been able to do is we've been able to create, I don't know, I wouldn't say first mover advantage, but we've created a significant competitive advantage. And so instead of going to investors and saying, okay, the minimum investment, whatever that might be, is not enough. We also need someone with strong technical skills. It sort of shuts out many people. And there are some investment firms that operate that way. So when we did our founders round and our seed investment round, we sort of satisfied ourselves, because many of those investors either come from mining or mining investment, or they're professional geologists. We've already satisfied that. So through our initial funding right now, we can accept money from, say, family offices, whereby they may not have a dedicated mining or materials team.
Yes.
They may not have had any exposure to the sector whatsoever. So they're also looking to us to be able to guide them, and being able to come into a portfolio that's already diversified sort of removes the onus from them to have to create their own team. That can be expensive, to create their own portfolio from the ground up and then have to monitor it. They don't have to do any of that. We're the specialists, we're doing it. But then again, you're not going to, a specialist investment management firm actually buying stocks in the secondary market, because we're actually giving you access to those issues at the seed level.
Yes.
So there are a number of benefits that are involved in, investing with Pan Pacific.
Yeah, and building that relationship early with the right investor too is critical, because you're going to be able to build and grow with them and provide all these solutions that they may or may not have as well. So this is what I was really attracted to, not only because of the timing and because of the specific skill set that you bring to the table, but it's because that you've positioned this And I hesitate, but just for a generalist, it's almost to some degree like an ETF or a fund in which you're getting a portfolio and you're getting this whole team of dedicated analysts and knowledge base that you wouldn't get otherwise.
Right, right. And again, it sort of comes back to market structure. You mentioned ETFs, which is something that we didn't see. We saw it in the last cycle, but not before then. So the ETFs were interesting. You could look at it as a trial balloon. What happens when you can offer investors easy access in the same way they buy a stock through their broker to a part of the investment market that typically would not see retail or somewhat unsophisticated money. The ETFs solved that. And it was Marcus Grubb at the World Gold Council was kind of behind that effort. And we've seen, billions and billions of dollars have gone into ETFs, and I think there are maybe 13 gold ETFs that I know of around the world. Yeah. So the model of being able to offer something that does not require one to have decades of experience in the commodity market, that works. Yeah. The ETFs proved that it works. Yeah. So in a sense, what we're trying to do is we're trying to take the next step and say, okay, if you have a lot of money, regardless of your experience level, would you not want to invest at the seed level? Well, of course you'd want to invest in the seed level, but it's very difficult to do that. Yeah. Venture capital firms typically reserve those for their best clients, and you're sort of shut out. With us, we're offering that access without you, again, having to be a long-time client, long-time investor. We think that should succeed.
I liken that too, is that people say to me, Andrew, what's one of the key advantages of being in Vancouver in the mining sector? And I say, well, it's the people, and it's also the deal flow origination. If I attempted to get into the tech sector in San Francisco, I'm never getting into the next Alphabet deal. I could spend my entire life trying to socially climb that ladder to meet the right. I'm never getting in. Yeah. Like that list is already full. But in the smaller mining sector that's now about to have its cycle and have its run, yes, you can get in. So people go, well, how do you get in? Well, this is how. So these are the type of conversations and relationships of people that have that skill set, that have the expertise and the resume to prove it, that are originating these deals and setting people up still early, before this really takes hold. And this is what I found so exciting with talking to you and the unique opportunity that you bring. And hopefully we'll get a lot of feedback too from people to reach out to you, because this is really taking advantage of a very unique moment in time.
It is, yeah. There is a window of opportunity. We'll see how long it remains open. But right now, we're seeing values. We're seeing properties available, and quite frankly, kind of as dumb as it sounds, mining is an extremely fragmented market, and we're capitalizing on that. So fragmentation of the market, illiquidity in the securities, distress at the company and the property level. We think that we can turn that into a pretty powerful investment theme. I think based on the initial response, there is interest from quite a number of investors in Asia, in Europe, and in North America. And we haven't really said a lot about our model, but the little that we have spoken about has attracted some, I wouldn't even say curious, just without getting into the names, there are some investors out there that specifically want to position themselves in projects that will be producing 7, 8, 9, 10 years from now.
Yeah.
Yeah. And so there are a number of ways to do it. And I get it, from a cyclical perspective, there is an intimidation factor associated with investing, particularly in junior miners. When you have the professionals who are going to be assembling the portfolio, we find that intimidation goes away. Again, especially with our model, we're not buying stocks in the secondary market. We're going down to the property level, and we're getting our technical people involved, and they're advising on whether to go forward. We think that gives investors in Pan Pacific a lot of confidence. And so again, investors who possibly want to use their investment ultimately to acquire the metals can use Pan Pacific to do that. And we're very well structured to be able to offer that opportunity quite easily. So I think they sense that, and I expect to be having a number of those discussions this week.
So if someone wants to get involved with you? Would they just contact you directly? Just check the email, say at Pan Pacific, or?
Sure. They can contact me, fjones@panpacificinvest.com. We are actually coincident with the Minds and Money conference. We also launched our first funding. It's it's small. It's 10 million USD. We expect to fill it out completely. They can participate there. It's not super seed level, but it's early enough because we do intend to do successive fundings at higher and higher valuations. So it might not be a bad idea. We're in the first third of our portfolio construction process. Future fundings are going to go to develop the companies that we have in the portfolio. So if people are looking to get in, I'd say a bit closer to the beginning, they might want to consider this funding.
Yeah, and this is really, it is great because it is that in ahead of the curve kind of idea. If you want to talk to Fred, reach out to him directly. Of course, send me a message as well. Reach out to me, I can direct you to him. But this model, I think we're going to see more of it down the future, especially when you see some success come out of you guys as well, which of course I wish you the best. But once again, $10 million they're looking to raise right now. It's I think you're going to find it open to that. I think you'll have a good market. But once again, happy to have you here, Fred. I really appreciate your time.
Andrew, thanks for the invitation.
Click that like and subscribe button and go sign up on superchargedstocks.com. Let's keep you notified.